Hi, everybody. Welcome back. This is Sam from Traders Insight. I'm here with Matt.
Hey.
And Matt and I are going to do a little review of the Iron Condor trades that I put on yesterday. So in the video yesterday, I talked about putting an Iron Condor on GoPro, and how to set it up and what to do. So today we're going to review what actually happened and see if it's a viable strategy, and actually go over some other strategies as well too.
Yeah.
So as you can take a look, I actually lost money on this as a whole. Well, no, that's profit loss. Is it today?
Yeah, that's today. Yeah, so that's the P&L today, but that's the P&L open at the moment.
Yeah.
So you've already closed in a number of positions.
Yeah, and the problem was that everything was going fine. The one that really caught me off guard was ISRG. So ISRG, if we can see, I don't have the trade prices here anymore, but ISRG jumped twice the expected move. Let's take a look at the chart actually, and we'll come back here. So ISRG jumped from, I think the expected move was 30 points, and I'm pretty sure. Let's go back and take a look at the trade monitor. So the trade that I put on was for just to test this theory that I had, is for the 535 calls, and so I placed my stops about here, and it blew right through. It blew through twice that, so it made what is that? I don't know, 3 or 4 standard deviation move away from the mid price or the previous price from the day. So it moved quite a bit, and I went max loss on that, which it wasn't too bad. But then Apple made a big move down as well too, and I woke up and I had a whole lot of negative in the morning. Thankfully, GoPro didn't move that much. Yahoo didn't move that much. Microsoft didn't move that much. However, I didn't really make that much money off of them in the end. I made $360 off of Yahoo, $216 off of Microsoft. GoPro was $500. I made max profit on GoPro, but the Microsoft trade was a little bit lower. I think max profit was $400. I just wanted to get out of the trade, and I think the Yahoo trade, the max profit was also around $450 as well too. So all in all, it didn't work out that great. If I hadn't have had ISRG, which is kind of a late addition to the stocks that I wanted to do the Iron Condor on, I think it would have been fine. And I actually would have made a good profit on this. And yeah, no, ISRG took me down about $800. So I'd be about $500 in the red if I hadn't have taken ISRG. So I woke up and I was like, oh, God, this is terrible. Matt, what do I need to do? And Matt came and we sat down and we took a look at my positions. And you can see here what I did with Apple is I rolled my call side down. So previously it was at the 138, 140, and I rolled it down to the 126, which is still on and getting tested actually. And then I sold the put, which I probably should have sold both just when they got to break even. But for some reason I didn't, and now I'm still down a little bit of money. But that's learning for you. And I think I tried to do the same thing on ISRG, but I didn't get filled. I wanted to roll the 462 up to the actually 535. I think it was 535, 532 puts, just to pull in some. And so the reason for this, as you explained, was that we roll up to collect more credit and try to make up the loss, and then additionally, try to roll the. No, we don't roll the in the money side.
No, so you never really touch, or at least I never really touched the tested side. I always touched the untested side. And if you've established something at one standard deviation, let's say your put side's getting tested, your call side is not going to be at an 84% probability of being out of the money anymore. It's going to probably be close to a 97, 98%. Yeah. So why not just bring that down back to its original 84%? You collect X amount of credit, which helps offset your risk.
Yeah. So all in all, I guess I would say this strategy is probably on par with going directional, at least in my opinion right now. We've only done 5 so far, and
I think you need to do more. I think the main takeaway with Iron Condors, at least from my experience, I always started off with doing just very, very wide spreads before I started doing naked.
Yeah.
I do strangles for earnings now. Is that you don't take advantage, you don't get the benefits of the vol crush enough after earnings, because essentially that's what you're playing for earnings. You're looking for the vol crush straight away as soon as the announcement's made. And with Condors, with aint Condors, you don't really seem to benefit 100% from that volatility crush.
Yeah. So we were actually talking about some other strategies that you could do and trying to figure out which one would be the best one. So another one that you explained to me is just going straight naked, which it scares me a little bit during earnings time.
I do naked one standard deviation strangles all the time. Obviously, the key is to stay small relative to your account size, so you don't get blown out on one 3 standard outlier move. And you need to learn how to manage trades properly when they go against you. You guys watch Tasty Trade, and they have plenty of, from what I've seen, they have plenty of back testing for strangles on earnings, which over time proves to be a winning strategy.
Yeah, I know. It's like, what is it, 83% of the time, or exactly what the standard deviation is, that they move within the expected move.
Yeah.
So let's actually talk about some different strategies. All right, so we're going to take a look at Amazon, which has earnings tomorrow, and we're going to talk about some directional plays that you can do. Directional, non-directional. So the two non-directionals that you could do would be selling aint Condors.
Yep, or strangles.
And here, we have all the strikes open. Let's take a look at, let's change this to out of the money. We'd be looking, two standard deviations is around, 98%? Or 94%?
It's 95.4% or something.
Okay, so we'd be looking at the 412. So if we wanted to sell naked calls, let's set up a strangle here and see what we would get. So we'll sell the 412 and a half.
So the 95% is overall, so you want to be going around 2%, 2.5% on either side. So you want to be going to 97.5% out probability of being out the money on either side.
So was that 400?
Yeah.
Probably want more air room than less on these strangles. And let's come down here. Oh wow, we gotta go really far. Really, really, really far. Oh my god.
So what happens when volatility is 127.2%?
Yeah. Okay, here we go. 97.5.
Yeah. I mean, the thing is, when the market closes like this, doing it when the market closes, look at the skew, like the bid-ask spread.
Yeah. Wow. Look at this. This is 100 point.
So it's never too effective doing it after market, but
yeah.
In terms for hypothetical examples.
There we go. Collect the dollar. It's okay. I mean, you'd be better off doing other trades on this one.
Yeah.
Let's talk about some of the other. I'm going to pull this down to. Actually, no, I'm not going to pull this down. We're just going to go back to the at the money strike. So directionality would be a little bit better, almost in this case. So we could do a Jade Lizard, which is one thing that we could do. I kind of had the idea of either selling or doing a what would it be? Just buying a call and selling the expected move, right?
So it's a debit spread. It's just a wide debit spread, and you're just using you're using the expected move to sell a call.
No, but I'd be selling. It would be like you. So I'll just set it up. Let me get rid of this. So we buy this, right? We go to blast all, and then we come down to the expected move is 40. So 520. Probably want to go a little bit further. Maybe let's go to the one standard deviation. So like here to the 542, right? We're going to sell these, but let's take this down to 1. And I was saying that we could set up the delta on this. So here we've got a 53 delta, and here we've got a 18 delta. So 18, 36, 54. So if we sold 3 to 1. We'd have a somewhat delta neutral strategy. We'd be buying the call for $22. We'd be collecting around $15.
$13.50.
Around $15 in credit. So we'd be paying about $5 for this trade. And obviously, if you get blown through, you're going to have some issues. But if it stays within the expected move or even goes over the expected move, you'd probably still, have a bit of upside. Actually, let's set this up in the Analyze tab because I kind of want to...
Well, if you click on Confirm and Send, maybe it gives you your information.
Here we go. So the cost of the trade would be 14,000 in buying power. So we'd essentially be the reduction in buying power would be from having to cover the cost of the possible expected move up.
Yeah, with how the Nasdaq's performing at the moment, I'd probably be on the long side of Amazon tomorrow.
Probably want to go a little bit higher. Maybe we could go down to like a 2 standard deviation.
We could.
So that's one idea.
Yeah.
What was your idea? It was selling buying an at the money call if we're bullish on this, and then selling credit spreads. Was that what it was?
Yeah.
Like call credit spreads.
It was essentially doing it's essentially that. So it's buying a call, an at the money call, and then selling some at the expected move call credit spreads just to see how it works.
So the expected move is 40, and it's 520. We probably want to go a little bit further.
No, let's do at. Let's do it at. Let's try it.
We're at 488 right now, so that's 528.
Yeah.
So what
let's do 530.
530.
Sell vertical. Let's just do a 1 strike wide.
So we would collect. Let's see, confirm this in. So we collect 550.
Yep.
And a lot less buying power.
A lot less buying power, but you're taking a much more directional assumption.
Yeah.
I mean, the opposite trade to this, similar trade to this, which I would prefer to do, is something like a Jade Lizard. If I'm bullish on Amazon, I'm going to sell a naked put, maybe at 1 standard deviation, and then going to sell a call credit spread to try and, between the credit received from the naked put and the credit received on the call credit spread, try and wipe out the spread difference between the spread.
Yeah, but I mean, you got to be right directionally on these. I mean, some of them you can have a gut feeling about what's going to happen, but other times, I had doubts about Apple. Everybody's been reading about the Apple Watch and how it's not very good. I mean, would you get an Apple Watch?
No.
I would. I mean, I would have one, I guess. Show all my friends.
I think I'd have paid to wear one of them. I think.
Oh, come on! I think it'd be cool.
I mean, essentially, I use strangles. All my earnings, overall, my earnings plays are successful when I use strangles. Mm-hmm. I understand how to manage them. I understand how to manage when I'm being tested or something's blown through.
Yeah.
Predominantly, 95% of my general day-to-day trading strategy is strangles at around the 1 standard deviation level. So, I mean, in terms of a general strategy for earnings, to me, strangle's the best. You just need to understand how to effectively manage them.
Yeah.
Because that's when you start getting into trouble. I mean, look, if you want to take a directional assumption, take a directional assumption, but at least do it better than either buying outright stock or just buying calls. At least do it in some sort of way where, maybe you're selling a put, you're bullish, and you're selling a call credit spread. Or you're buying a call, fine, and you're selling a call credit spread.
Yeah.
I mean, what you've got to remember as well is that, all you have to do is look at the bid and ask and look how inflated they are due to the 127.3% implied volatility.
Yeah, it's huge.
So if you look at the intrinsic versus extrinsic, I can imagine there's going to be a big differential between now and after earnings.
Yeah, look at that.
Yeah.
And if we come to theoretical price, let's close this down. And so normally it's around 36. So if we vol reduce this by about 90, we can see that prices will go for the at the money strike down to about $12 for that call. Mm-hmm. So you're going to see about a reduction in half almost. For the vol adjustment after earnings.
And if you put the intrinsic and extrinsic back on again,
mm-hmm.
it's precisely why we sell in extrinsic value and buy intrinsic value. I mean, you look at the at the money call there, it has an intrinsic value of 80 cents and an extrinsic of $21.
Mm-hmm.
So, I mean, in relative terms, why would you ever buy a call? before that, why would you ever buy a core extra buying the extrinsic value?
Oh, during earnings?
Yeah.
Oh, no, you never would. I mean, or do a straddle or something. There's no point.
No.
Because you'd have to go way... You would have to have a huge move.
Yeah, it's actually one of my... There was... A while ago, there's a market measure segment on Tasty Trade. I think it was taking Goldman Sachs, and they were talking about why you should be buying a straddle before earnings.
Yeah.
And they basically just obliterated the whole stupid, ridiculous concept of what Goldman's had.
Well, so that's the... Well, we're not sure if it's a bad trade yet. I'm gonna do some more of these iron condors.
Yeah.
And
I mean, I stick to straddles. I like having to play around with different strategies every now and again on smaller contracts.
Yeah, we're gonna keep on. Well, I'm gonna do a bunch more of these iron condors in the coming days. I'm gonna tally them up and see how I would do.
Yep.
I'm gonna go a little bit further out. Maybe I'll try to do 1.5 standard deviations, collect a little bit less credit, shorten up the strikes, and see if I can make it a bit more profitable for the future.
Yep.
Yeah.
Absolutely.
Maybe come out with a little bit less risk. Maybe go 4-to-1 risk to reward.
Yep.
And see how I do. Because all of these were pretty much 2-to-1 or 2.5-to-1.
Yep.
So I think if I go 4-to-1 risk or reward, maybe it'll be a little bit better.
I mean, that's the beauty of earnings. High vol allows you to get further out.
Yeah, exactly. All right, thanks, guys. And we'll have another update later on.
Yep. Stay small, stay naked.
And don't forget to subscribe if you guys like the videos. We want to keep on making these, and we want to know that you guys like them. So make sure to subscribe.